If you're planning a $100,000 Roth conversion this year, you've probably heard the same advice everyone gives. Never withhold taxes from the conversion itself. Instead, get ready to write 4 separate checks to the IRS for quarterly estimated payments. Almost nobody mentions the alternative. If you're over 59 and a half, there's a specific IRS rule that lets you skip those 4 checks entirely without breaking a single law. It's called IRC 6654T1. The IRS built this rule into the tax code, and in a strange way, it actually prefers you use it. The rule lets you take one lump sum of withholding late in the year and treats it as if you paid it in 4 equal pieces, spread evenly across the whole year. Use it correctly, and you can avoid the 7% underpayment penalty the IRS is charging right now in the 3rd quarter of 2026. That's on top of skipping the quarterly paperwork most retirees dread. But there's a catch that trips up a lot of careful, well-organized people. If you live in California or New York, this same legal move that keeps the IRS happy can hand you a state penalty of up to 7.5% because your state does not follow the same rule the federal government does. I've watched people follow every federal instruction to the letter, feel good about their planning, and then open a letter from their state tax board a few months later wondering what they did wrong. They didn't do anything wrong exactly. They just didn't know the IRS and their state government don't talk to each other. Over the next few minutes, I'll walk you through the withhold and replace math the IRS actually prefers and the one state tax trap that could quietly cost you thousands if nobody ever points it out. Start with the mechanism, because once you understand why this works, the rest of the strategy makes a lot more sense. The IRS calls it the deemed paid rule, and it comes from IRC 6654TG1. Normally, when you owe estimated taxes, the IRS wants 4 payments spread across the year, 1 every quarter. Miss a quarter, and you owe a penalty for that quarter, even if you pay everything in full by December. Withholding works differently. Any tax withheld from a paycheck, a pension, or an IRA distribution gets treated as if it were paid evenly across all 4 quarters, no matter when the withholding actually happened. Withhold in November, and the IRS books it as if a quarter of it arrived back in April. That single difference is the whole strategy. Here's how it plays out in practice. Say you convert $100,000 from a traditional IRA to a Roth IRA. Instead of paying estimated taxes quarterly, you instruct your custodian to withhold 24% for federal taxes, which comes to $24,000. Normally, that would mean only $76,000 actually lands in your Roth account. But within 60 days, you replace that $24,000 using cash sitting in a taxable brokerage account, moving it into the Roth. The result is the full $100,000 ends up in your Roth IRA, $24,000 is paid to the IRS, and because it was withholding rather than a late estimated payment, you owe $0 in underpayment penalties. You worked 30 years to build this nest egg. You shouldn't lose a piece of it just because the IRS runs its estimated payment system on a quarterly calendar that has nothing to do with your actual cash flow. Most of the advice you'll find online stops right here. It treats the withhold and replace move like a universal fix, something that works the same way no matter where you live. That's exactly where it quietly falls apart. Saving yourself from a federal penalty does nothing to protect you from a state one because the IRS and your state tax agency run on completely separate rule books. If your state does not recognize the deemed paid rule, you can do everything right by federal standards and still get flagged for underpayment back home. That gap between the two systems is exactly where things start to get expensive, and it's worth understanding before you convert a single dollar. Think of it like paying your mortgage 2 months late, but backdating the receipt so the bank never notices a missed payment. That's roughly the accounting trick the deemed paid rule performs for federal taxes, except it's completely legal and built directly into the tax code. The problem is your state tax office isn't the same bank, and it doesn't accept the same backdated receipt. Here's the part of this strategy that separates a clean plan from an expensive surprise. The IRS built the deemed paid rule for federal purposes only. States write their own rules, and many of them never adopted anything close to it. California and New York are two of the biggest examples, and if you live in either state, this matters directly to you. Both states require estimated payments based on when your income actually shows up, not on some averaged-out version of the year. So when the IRS treats your December withholding as if a quarter of it arrived back in April, your state tax agency is not required to see it the same way. In California and New York, it usually doesn't. States are not required to mirror federal tax procedure, and most only adopt the version of a rule that's easiest to enforce on their own timeline. That's not anyone acting in bad faith. It's simply how state revenue departments are built, collecting money in the quarter they believe it was earned, not the quarter the IRS decided to average it into. Picture a retiree in New York doing a $100,000 Roth conversion in December. On the federal side, everything works perfectly. The withholding covers the tax bill. The deemed paid rule spreads it across the year, and no federal penalty shows up. New York State sees something completely different. It sees a large spike of income appearing in the fourth quarter, with nothing paid in the first, second, or third quarter. New York's minimum underpayment penalty rate sits at 7.5%, and the state applies it to that gap, regardless of how clean things looked on the federal return. I used to think of the withhold and replace strategy as a universal win, something that worked the same for everyone, no matter where they lived. Then I saw a client in California do everything correctly by federal standards and still get hit with a penalty notice on Form 5805 simply because California never adopted the same timing rule the IRS uses. Here's what that actually costs in dollars. Take a $100,000 Roth conversion for someone in California's 9.3% state bracket. That's $9,300 in state tax owed. If that entire amount is paid only in December through withholding, California can look back at the first 3 quarters of the year, see no estimated payments were made, and assess an underpayment penalty on that gap, even though the full $9,300 eventually got paid. That's the trade-off hiding underneath this whole strategy. You're not choosing between paying a penalty and paying nothing. You're choosing between a federal system that rewards year-end withholding and a state system, in certain states, that punishes exactly the same behavior. None of this means the withhold and replace approach is a bad idea. It means it needs to be checked against your specific state's rules before you rely on it, not after your custodian has already sent the withholding through. If you're the kind of retiree who handles your own tax planning and wants to keep as much of your money out of state treasurers' hands as legally possible, this channel is built around exactly that kind of math, the kind most standard advice skips over. Subscribing helps you catch traps like this one before they show up in a penalty notice instead of a video. New Jersey belongs on this same caution list. None of these 3 states are trying to trap anyone on purpose. They're running older tax procedures that were written before backloaded withholding became a common retirement move, and nobody has gone back to update them for how people actually convert accounts today. It helps to understand why this penalty matters as much as it does today. Underpayment penalties are tied to interest rates, and interest rates have not stayed still. The IRS sets this rate every quarter, tying it directly to the federal short-term rate plus 3 percentage points. That's exactly why a shift in Federal Reserve policy in 2022 turned a minor inconvenience into a real cost within a matter of quarters. Back in 2022 and 2023, as the Fed raised rates to fight inflation, the IRS underpayment penalty rate jumped from around 3% to 8% in a fairly short window. That roughly tripled the cost of getting your estimated taxes wrong in less than 2 years. At the same time, the dollars involved kept climbing. According to the IRS data book, the agency collected more than $1.8 billion in underpayment penalties in a recent fiscal year alone. That's not pocket change collected from a handful of people who forgot to file. That's a system quietly pulling money out of a large number of retirement accounts, one missed quarter at a time. I remember when a lot of retirees treated the estimated tax penalty as background noise, a small cost of doing business that wasn't worth the hassle of avoiding. At 3%, maybe that was fair. At 7% or 8%, it isn't anymore. Think about what an 8% penalty actually does to a retirement portfolio. If your safe withdrawal rate already sits somewhere around 4% a year, a penalty running at 7% or 8% on even a portion of your withdrawal isn't a rounding error. It's a meaningful drag on money you were counting on to last decades. That's the backdrop that makes the withhold and replace strategy worth learning properly, instead of treating it as an optional trick for people who enjoy tax paperwork. And unlike a market downturn, this is a cost sitting fully within your control to avoid simply by understanding how the timing rule works. Put it in everyday terms. For a couple pulling $80,000 a year from savings, an 8% penalty on a $20,000 shortfall works out to about $1,600 gone. Before a single dollar goes toward groceries, insurance, or a mortgage payment. That's real money, not a rounding error on a tax form. There's a second trap sitting right next to the state tax issue, and it has nothing to do with penalties at all. It has to do with Medicare. Every Roth conversion adds to your modified adjusted gross income, or MAHWI, for that year. Your MAHWI from 2 years earlier is exactly what Medicare uses to decide how much you pay for Part B. Push your income over a certain threshold, and your premium doesn't rise a little. It jumps to an entirely different tier. For 2026, that threshold sits at $206,000 for joint filers, based on current inflation projections. Cross it, even by a small amount, and instead of paying the standard Medicare Part B premium of $202.90 a month, you could find yourself paying anywhere from $284.10 to $689.90 a month instead, depending on how far over the line your income lands. Here's why this matters for the exact strategy we've been talking about. A $100,000 Roth conversion designed carefully to avoid a federal penalty, and a state penalty can still push your MAJ straight through the IRMAA threshold if nobody checks that number before hitting convert. A conversion that looks perfectly sized for your tax bracket can still be the wrong number once Medicare enters the picture, and that's a check worth running before you call your custodian, not after. Picture 2 versions of the same retired couple. In the fragile version, they successfully skipped their quarterly payments using withhold and replace. Feel good about avoiding the penalty, and don't realize their conversion pushed them into a higher IRMAA tier. 2 years later, that mistake costs them close to $8,000 in extra Medicare premiums, stacked on top of whatever they saved on the penalty side. In the more resilient version, the same couple uses the exact same withhold and replace mechanics, but caps the conversion just $1 below the IRMAA threshold, keeping every other piece of the strategy intact. It's a strange feeling, opening a thank you note from the IRS for handling your withholding correctly, and a bill from Medicare in the same stack of mail. This is the part of Roth conversions that rarely gets discussed alongside estimated tax planning, even though the two issues are tied together by the exact same number. Your Maj Y decides both your penalty exposure and your Medicare premium, which means the size of your conversion has to be checked against two different thresholds, not just one. That's not a reason to avoid converting. It's a reason to know exactly where your ceiling sits before you decide how much to convert this year. The 2-year look-back is what makes this so easy to miss in the first place. The conversion you do this year doesn't show up on your Medicare bill until 2028. By the time the higher premium arrives, the conversion that caused it feels like old news, and it's easy to blame the wrong year or the wrong decision entirely. Checking the threshold before you convert costs a few minutes. Sorting it out 2 years later costs a lot more. Let's put this all together with a real scenario, because the numbers only mean something once you see how they behave under pressure. Mark and Sarah are 62, living in North Carolina, a flat tax state that generally follows the federal government's timing rules. They want to convert $150,000 this year to fill up the 24% tax bracket while it's still in place. Then, in October, the market drops 20%. Picture how this plays out for a couple who paid estimated taxes the traditional way, in April and June, based on the $150,000 conversion value they planned at the start of the year. By October, their portfolio is worth significantly less, but they've already sent the IRS a check calculated on the higher number. They overpaid, and worse, that money isn't sitting in their account earning anything. It's already gone, tied up until they file next year and wait for a refund. Now picture Mark and Sarah using withhold and replace instead. Because they never made quarterly payments, they haven't locked themselves into anything yet. When the market drops in October, they still have the flexibility to lower their conversion amount to $120,000 matching, where their portfolio actually sits, instead of the number they projected back in January. Their tax bill shrinks along with their portfolio, and the cash that would have gone to quarterly payments stayed invested, or at least stayed in their control the entire time. That flexibility is the quiet benefit sitting underneath all the penalty talk. Estimated payments lock in a number early and ask the market to cooperate. Withhold and replace lets you wait, watch, and adjust right up until the moment you actually need to act. It doesn't remove the state tax and IRMAA questions we just covered. Mark and Sarah still need to check both before finalizing their number. But it does mean they're not locked into a decision made months before they actually knew what the year would look like. That kind of flexibility matters more than it sounds. A car repair, a new insurance premium, or a slow quarter for their taxable brokerage account, any one of those can change what number actually makes sense by December. Estimated payments don't leave room to react once the checks are already in the mail. Withhold and replace keeps that door open until the moment you actually need to walk through it, rather than closing it back in April. Here's exactly how to actually put this to work, step by step. Start by checking whether your state follows the federal deemed paid rule at all. California, New York, and New Jersey are the states worth treating with real caution, since none of them fully mirror the federal timing rule the way North Carolina and many other states do. You can typically find this by searching your state tax department's estimated tax penalty page directly, since these rules do change and the version you read last year may already be outdated. A few minutes checking your specific state's rules can save you from a penalty notice arriving months after you thought the whole thing was settled, long after the conversion itself is done. Next, think about the timing lever inside this strategy, because most people miss it entirely. You don't have to convert and withhold at the same moment. You can convert early in the year, in January, for example, to get as much tax-free growth inside the Roth as possible. Then you wait until later in the year, closer to December, to actually trigger the withholding distribution. That keeps your cash sitting in an account earning interest for most of the year, instead of handing it to the IRS the moment you convert. Third, respect the 60-day window on the replacement step and understand its biggest limitation. The IRS only allows one indirect rollover like this per 12-month period, across all of your IRAs combined. If you've already used that window for something else this year, this strategy isn't available to you again until the 12 months are up. That's not a small detail. It's the one rule that can quietly shut the whole plan down if you're not tracking it carefully across accounts. But what if the cash to replace that withholding isn't sitting in a savings account, ready to go? A lot of retirees don't have $24,000 in loose cash waiting around for exactly this purpose. There's a third path worth knowing about, one that involves how you handle your required minimum distributions instead of a separate brokerage account, and it's worth understanding before you assume this strategy is only for people with extra cash already sitting on the sidelines waiting to be used. If your required minimum distributions from other retirement accounts are already scheduled later in the year, you can route some of that distribution's withholding toward the same purpose, rather than pulling fresh cash from a brokerage account at all. It takes a little more coordination with your custodian, but it means the strategy stays available even in a year where your savings account isn't flush with extra cash sitting around. None of this is complicated once you've walked through it once. So why do so many retirees stick with the quarterly check anyway, even when it costs them more? Part of it comes down to what feels safe, not what actually is safest. Writing 4 quarterly checks feels familiar, almost like an old habit. Reversing withholding through a 60-day rollover feels like something that could go wrong, especially if you've spent your whole working life a little wary of ever attracting the IRS's attention. That's completely reasonable. Nobody wants a letter from the IRS, and the fear of an audit is a powerful enough deterrent on its own that plenty of people would rather overpay a little than risk doing something unfamiliar. That's worth sitting with for a moment, because the fear isn't really about the math. It's about doing something unfamiliar with money you can't easily replace. You don't have to switch your entire strategy over in one move. Try it small first. Run a mini conversion of $10,000 this year, using the withhold and replace method, just to see how your custodian actually processes the paperwork and how the 60-day window feels in practice. Once you've done it once at a small scale, the version with real money attached stops feeling unfamiliar. Simplicity isn't always about having fewer steps. Sometimes it's about having less to worry about. Once you've walked through this process a single time, the anxiety around quarterly deadlines tends to fade, even though the mechanics themselves didn't get any simpler. I've seen people put this off for years, not because the math was hard, but because the first attempt felt like the highest stakes version of a new skill. It rarely is. A small conversion carries small consequences, even if you make a mistake with the paperwork the first time around. Here's where all of this lands. The withhold and replace strategy, built around IRC 6654 TG1, is one of the more useful tools available to retirees doing Roth conversions in 2026. But it only works cleanly if you check it against two things first: your state's tax rules and the IRMAA thresholds tied to your Medicare premium. Skip either check, and the strategy that was supposed to save you money can quietly cost you somewhere else instead. If you want help tracking IRMAA tiers and state-estimated tax rules as they change each year, staying subscribed is the easiest way to catch updates like this one before they turn into a penalty notice. We're focused on helping people in their 50s and 60s retire with more of their own money and less of it lost to tax drag they never saw coming. The tax code changes more often than most people expect, but your retirement plan doesn't have to change with every update. You just need to check the two numbers that matter before you convert, not after. That's the whole difference between a clean conversion and an expensive surprise, and it's a difference that stays entirely within your control. Year after year,